Well, good morning, John. Good to see you. We're recording this on Thursday morning. Following important inflation news out of the US, unfortunately, inflation came out a little bit higher than market expectations. Wall Street has generally given up about 1% overnight, and our market has opened weaker. John, give me your take on the inflation numbers. It certainly appears that interest rate cuts are now off the table, at least for probably another, few months. What's your take?
I think that's a good read, Paul. I think the American market is now obvious. I guess there's been a lot of talk about interest rate cuts and they're speculating 3 or 4 this year, but now we're probably down to 2 later in the year. Inflation is bobbing around 3.5% annualized. Recent numbers are taking it in the midpoint between 3.5 and 4. When you look at the components, most of it is reasonably good, but just looking at the numbers, then the electricity's become an issue again in America. So the transition to green energy, as we always knew, I guess, Paul, you've got a view on this, that is always going to be inflationary. And we're seeing the effects of the transition coming through. In terms of fuel, as we noted before, fuel in America has been held under control, so petrol, gasoline. So that's helped a lot of the services inflation, because the two parts of services are the cost of fuel and the cost of labour. It's going to be interesting how governments respond, and I guess America's on a different response mechanism to Australia. But let's just look at the knee-jerk reaction. First of all, we had bond yields going up, so the 10-year bond in America has gone back to 4.5. So it's gone from 5 to 3.9 to 4.5, and 4.5 is, as I just said, 1% above inflation. It's 1% below the cash rate. So is that fair price? Probably is. The whole yield curve has gone up slightly. The market has said the cash rate adjustments are going to be delayed. In Australia, we've had our bonds go back to about 4.25, but they not much different to where they were a month ago. They did breach 4, but they're back to 4.25. But the Australian dollar went back to 65 cents, and that's our inflationary issue, is our weak currency. So interesting what the central bank's going to do. I keep on saying, and there's a great debate about it, where Australian interest rates should be. There's a lot of pain being suffered by mortgage holders. And that's affecting retail sales and sentiment. The RBA knows that, but then you get some people saying they should put up interest rates. Well, that would be a killer for the economy. It's a very interesting dilemma for the Treasury coming up.
Yeah, it certainly is. But the United States is growing very strongly, around 2.5, a touch above that, whereas Australia is growing much, much more slowly. And as you pointed out, business confidence, consumer confidence, both giving low readings. Retail spending's pretty poor. I mean, Australia's sailing a lot closer to flat. Why are we underperforming the US so much? Is it sort of the composition of our economy?
I think so, but I also think there's not enough attention put to government stimulation. I mean, Australia's running a surplus, and the Treasurer is still, if you read the press and so the leaks out of Canberra, he still wants to run a surplus. Why? I don't understand. Then you've got the Prime Minister today saying he wants to support green energy transition. Well, that can't happen unless we run a deficit and the government starts using its revenue and borrowings to stimulate parts of the economy if we want to get back into manufacturing. And here we are in 2023 going back to supporting manufacturing in Australia. I know it's for a specific purpose of green energy, but we're rolling back the clock 40 years, Paul, because we took down all the trade barriers and destroyed Australian manufacturing, and now we realise, well, we want to bring it back for a whole lot of reasons and sensible reasons. I'm not knocking it, but it's going to be hard to bring it back. No shortage of capital. But I think the big issue about growth, to your question, look, America's running a 4% deficit and getting 2.5% growth, and we're running a 1% surplus and getting 1% growth. I think the numbers, it's the government sector it's the fiscal policy is not supporting growth, and we've got a treasurer who doesn't seem to understand that when the economy slows, you've got to start stimulating. When the economy grows quickly, then you pull back, and we're you know, it's an interesting conundrum. He's brought 500,000 people into the country. You don't do that unless you're prepared to spend to make sure that there's infrastructure and they're gainfully employed.
Some commentators responded to the CPI number in the US by saying that rate increases should still be on the table. Is that going a bit too far? Is that?
Well, I mean, we had that. You know, we're getting statements from Republicans, and it's disturbing. We've got the next head of the Federal Reserve potentially under a Trump administration saying that he doesn't see any reason to cut interest rates and maybe an argument to increase them. Well, that's what you would do if you're a Republican trying to slow the economy and win the next election. So it's quite annoying, and we should all be aware of it, that America is a bipartisan, terribly bipartisan economy. And when the regulators and Federal Reserve board members start talking politics or talking changes in monetary policy, which may have an effect on the economy and therefore the election, it's very dangerous. I maintain that 5.5% cash rates is very restrictive. The fact that the American economy is growing with that sort of restriction is good.
Yeah.
But it's reflective fiscal policy. Let's be real. It's absolutely reflective of a out of control fiscal situation in America. Now, solving the fiscal situation of America is not going to be done by increasing interest rates. If you think laterally, this is where macroeconomics is important. If you put up interest rates, you'll slow the economy, you'll slow tax collections, you'll increase social security, you'll make the budget worse. So they want to be very careful about what they're doing. Plus, the American government has $30 trillion of debt. You start pushing up interest rates and hold them there for a couple of years, and it feeds through to the bond market, you've got a significant issue in terms of servicing debt for the government. So I'd like a little bit more broad discussion by some of these, I won't call them crackpots, but that's at the beginning. There's not enough thought process about the longer term management of the American economy and the fiscal situation and the government debt.
Obviously, the competition of our share market very different to the US. We're much more dominated by resources and materials and so on. So news coming out of China over the last little while has been a lot more positive. I saw a note from Goldman Sachs this morning saying that they estimate that China in the first quarter of the year grew by an annualized 7.5%. And we've seen generally strong commodity prices. Even iron ore has bounced back to 109. How do you see commodities? I mean, the global economic growth is actually surprising on the upside, isn't it? And that's driving demand for commodities.
Well, you know, my presentations, I keep on reiterating the point that China and India and related countries of Asia with 3.5 billion people representing, you know, India and China representing around 25% of world GDP, growing at, you know, growth rates 4, 5 and above %. I mean, everything we're seeing is very predictable based on the logic of a lot of people, billions of people, moving from low class to middle class and demanding more for their, you know, their style of living. I mean, this is pretty basic stuff. Australia is a great beneficiary. We can go back and forth between India and China, but that growth is assured. I saw a panel conference reported in the Fin Review. You know, we had people talking about China's growth, and these economists saying, oh, there needs to be more stimulation from China so they get back to 5%, as if 4% wasn't good enough. And now you're telling me they're getting 7%. I mean, there's too many people talking about China and ignoring the fact that the American economy is a highly stimulated economy through fiscal deficits. You know, China and India will run deficits, but they'll be very focused deficits, will support their internal growth and support their standard of living. I mean, America seems to be running deficits more and more to service the debt they created over the last 4 decades.
John, I just want to stay on commodities a little bit longer. So in the last week or two, we've seen the gold price at new all-time highs, around 23.60, 23.70 even. copper price is strong. Some of the other metals are performing well. Is this part of a commodity super cycle? I mean, would you be suggesting that that's a good place for people to be investing in, or where does gold fit into a portfolio in your mind?
Well, like fund managers, at certain times you have gold exposure. You never look at them as long-term investments, Paul. If you want to have long-term investment, buy a gold bar, put it under your bed. But gold stocks eat capital, but there's a time to buy them in the cycle. And I guess we've got some exposure. I know we have got some exposure to gold, and that's a good place to be short term. Interesting that gold is holding up as a US dollar. Again last night, just make the point on international currency, Australian dollar plummeted about at one stage 1.7%. Well, so if you're holding US stocks, let's get back to metals, but US stocks, stock market goes down 1%, and from an Australian perspective, you made 0.5%. So even against that, and we're seeing the same thing. That the strength in the metals prices and gold is strength in US dollars. As a US dollar, everyone says people want to hedge against the US dollar, but the US dollar really is sustaining its value despite all the issues about its debt. It's holding its value, and metal prices are going up, measured in a very strong currency. So to your point about investing in that sector, you'd have to be in that sector. Sitting here in Australia with a currency hovering at 65 cents, I've said over and over again that the Australian dollar is not like it was in the past, driven by commodity prices or bulk commodity prices or metal prices or LPG prices. It's totally driven down by the excessive investing by Australian super funds offshore. They are constantly selling the Aussie dollar. Now, that's holding it down, which is good for tourism, but it's causing potentially an inflation issue in this country by undervalued currency.
John, the Australian dollar has been very weak, as you've said. The Japanese yen has also been
weak.
Very weak. And there's now talk that the Chinese might consider devaluing in order to make their exports more competitive. Is there a risk of some sort of currency war going on, or with competitive devaluations, or that's not on the cards?
Well, it is on the cards. I mean, Paul, we used to talk about everyone wanted a stronger currency. Now we all want weaker currency, and Australia's got a weak currency, not because of any policy, just because the superannuation system of Australia is bloated. Too much money going into it, not enough going into Australian investment. We have flagged in the past that China would contemplate a devaluation, which would be good news for world inflation. So let's put it on a tick box. And Japan's currency, I think Australia hit a high against the yen over multi-years on the ABC News last night. So we're weak and they're weaker. It's interesting stuff, but I guess that's the consequence when you print so much money, as they have in Japan, that you're eventually going to weaken your currency. And I think that's why the Japanese yen has weakened so dramatically against the Australian dollar, is because of that massive QE program, which they still undertake. So it's coming through on the currency. Is it good or bad news? Well, I guess eventually that stimulates the Japanese stock market, which it has, and it stimulates Japanese multinationals, makes them more competitive in the world markets. So does that stabilize currencies and then they start growing again and the currency goes up again? Time will tell, but it's all playing out as the macro logic says. The only thing we're not seeing is inflation.
Yeah. We're running out of time. I think there's probably time for just one last question. I noticed that in the US last night, as bond rates rose, the REIT sector was the worst performing. I think it was down about 4 or 5%. And this morning on the Australian market, REITs are taking it in the neck as well. Do you still think it's a good time to be investing in REITs and kind of harvest those higher yielding securities?
Well, they're levered entities, Paul. These are levered trusts, and inside the leverage, there are some trusts which are fully hedged. There are some trusts which have are rolling out into current market cost of debt. So it's going to be a volatile period. I suggest that on weekdays like this, where the market frets about interest rates and knocks down these levered financial entities, it's an opportunity to buy. But when they recover, when everyone's confident again, from a trading perspective, you probably let some go. I do think in the next year it will be time to buy property. I've been saying that on a longer term view. So I stick to that. Australia's economy, with population growth, it's very hard to say that the residential property market's booming, but every other part of the property market is going to fall. It's not going to happen. But there is an issue because whilst rents are rising, say on industrial and commercial retail properties, a lot of that rising cash flow is being eaten up by rising interest rates, and then you've got the cap rate valuations also putting pressure. So it's all short term. It'll work its way through. There's potential for overselling to occur, and being contrarian is always the way to be, thinking about it, but logically contrarian. So yes, I'd be looking to increase property over the next 6 months, and I'd be taking these opportunities to add. But when it gets ahead of itself, do a bit of trading against it.
Wise words. Okay, thanks, John. That we've got time for, and we'll have to leave the discussion for next week. Thanks. Have a good weekend.
See ya.